Investors and traders, welcome to the channel Market Chart Pattern. Today is 13th of June 2023. This video is for educational purposes only and it is not a financial advice. In this video, we are going to do something a little bit different to our usual format. We are actually going to take a look at some macro fundamental data coming out of the Federal Reserve System. So we'll be taking a look at the information they are sharing with us, meaning the public, about inflation and how the Federal Reserve Bank of New York is actually tracking that. So today we did have the CPI numbers come out. So those are the headline figures. I believe the figure was about 4%, which was the lowest in about 2 years' time. And tomorrow is also, I believe, the FOMC meeting. So probably we'll hear about the interest rate decision. So in this video, we are going to talk about, based on what we know about the inflation trend coming out of the Federal Reserve System itself, what the decision might look like. We do not know yet, but we'll have to actually look and see what the Federal Reserve Bank of New York is actually talking about, how they're looking at the inflation situation. So this is a MCT update for inflation persistence declined significantly in April. So that's the past April of 2023. And what they have a study here, which you can actually Google about by typing in Federal Reserve Bank New York MCT update inflation, some keywords like that, and it should bring up this article. And here, what I'm going to do is go right into the chart right here. So here what we have is basically a nice looking chart here. It has got these lines here, some shaded areas, and what we have here in the dotted line right here is the headline PCE inflation year on year. Then the this red slash maroon line is the core PCE inflation year over year, and then the blue line is what they call the multivariate core trend. And what we can see is this blue line has actually significantly dropped into the month of this past April. So what this chart is indicating is that actually the this multivariate core trend, which they have been tracking, has actually been declining and declining quite significantly. Whether this information is going to have some sort of an impact on the decision, which is likely to come out tomorrow, we'll have to wait and see. And but it looks like the studies going on within the Federal Reserve System are actually pointing towards a declining trend in inflation, which would, from a layman's perspective, mean that perhaps there is a possibility for a hold on the interest rate rising. Now it's quite clear from the press conference done in the previous month, when FOMC meeting was done to indicate about the interest rate decision, that at the moment the cutting of rates is not on the agenda, but a pause might actually be, but we don't know. We'll just find out tomorrow. So just to read from what it is, what is this MCT? So what the article says is the MCT declined in April. The MCT declined to 3.4% in April from 3.6% in March. The value of March was itself revised down considerably from 4.5%. Uncertainty is high, as reflected in the 68% probability band shaded area. So they have this shaded area which we see in blue. This is like a probability region, which is about a 68% probability inside it, the way I understand this. By comparison, the standard 12-month core PCE measure inched up to 4.7% in April, following monthly readings of 0.4% in April and 0.3% in March. Here's a little bit more summary of this. I'm just going to read it quickly. The latest MCT estimates revised down the recent path for inflation persistence from October 2022 to January 2023. The trend held steady at a level close to 4 and 3.25%. After exceeding 5% during most of 2022. Since January 2023, the trend has been on a steep decline. The sectoral decomposition shows that the decline in the trend was initially due to decline in core goods and now non-housing services inflation. In the last 3 months, however, a substantial moderation in housing played the biggest role. So you can read the rest of the article here, but what I wanted to just show was this chart indicating that the way the Federal Reserve Bank of New York is tracking the inflation using their multi-variate core trend model is actually on a downward trajectory, and according to the article it says that it declined significantly in in April of 2023. So that's kind of good news in terms of inflation getting cooled down, and certainly we saw the headline inflation figures today, which looked much better as well. So again, the question will be how the FOMC meeting is going to take all this data coming from inside of their Federal Reserve banking system, and what the decision might look like, whether they'll decide to pause, whether if they will still raise the rates, then we'll of course have to look at okay why they might be doing that, if such kind of reports are actually coming out of their own internal system. So now I want to bring your attention to another chart. So this is the chart of 2-year Treasury constant maturity rate. I have actually broken it down to 1 week. And based on this chart, what I'm trying to say is that why we believe the Fed may pause raising rates in near future. Now I'm just looking at the historic chart going back to 1981. So that's about 42 years, for a little over 40 years of data. And what I've noted is that the inflation, the rate for the 2-year Treasury peaked somewhere around August of 1981, and ever since there has been a decline in the yield, and whenever there has been a rally from a base to the peak, if that has been of roughly around 4%, sometimes a little bit above 4%, so anywhere between a 4 and a 4.5%, we have seen the rates actually peak and a decline in the yield, or the rates begin to happen, the yield for the treasury note. So if we just take that and copy this, clone this was another base area from here till here. This one was a little bit less than 4%. We clone this one was about 4.12. This one was about 4.15, and this is where we are. This one actually is around 4.5% or 4.5 in magnitude. It's gone a little bit above that, and this is where we are hovering right at the moment. Another interesting observation is that whenever there has been a kind of a second peak, what do I mean by that? So let's say if we take the example of this peaking in March of 1989, and then there was another peak formed in April 1990. Some recessions have actually followed. So I'm going to show another chart. We'll just quickly take a look at these second peaks. So this is around April of 1990. The second one is around April of 2000. This is the second peak of around June of 2007, and here we might be actually forming another peak of in the June of 2023. So the other chart that I want to show you is basically this one. It's an unemployment rate chart. However, these shaded areas which we see, they indicate a recession. So just looking at our data, so there we go. This is somewhere in 1990, 1991. This is somewhere around, I believe, 2000 and 2001. This is the 2009 one, and this was a very small, over 2020, March of 2020 COVID recession, which was very short-lived. So in fact, the chart says that the shading denotes NBER dated recessions. So NBER is obviously they look at the data which is a little bit behind, so there's a lag. Therefore, what we see is the official marking of a recession, and the kind of dates where we have seen these second peaks here. They might not be in 100% alignment, but again, this is just giving a general kind of a direction. So because of this, if this kind of analysis holds true, there's a good chance that actually the decision about the interest rate might be towards a pause. And what could also happen is, because it's a secondary peak, maybe there is a possibility of a recession. Whether there's something like this will happen or not, I do not know. But this is what we have seen when there have been a secondary peak. We have seen an official definition of a recession come through based on the a review of past recession chart coming out of the Federal Reserve System itself. So this is what we are looking at, and we'll find out tomorrow what is going to happen in terms of the interest rate decision. So one interesting observation is that based on what we have seen on the PCN multivariate core trend model telling us about the significant decline in inflation, and if still the committee decides to raise interest rates, then we'll have to actually also ask ourselves a question: why might that be happening? Where there might be something else in terms of data which we don't have access yet, and we'll have to just ask questions to understand why there might be a hike in the rates. Okay, so having looked at that, what we are going to do is we are actually going to take a look at the equity markets. We'll also briefly try to take a look at, if we have the time, the video doesn't become really long, on some bond markets as well. So our long-term subscribers will know that for a long time we have been actually looking at this ABCD pattern formation, which we had a target of about 44.30, and we are actually very close to that target. So today's high has been 44.23. So I'm actually going to go and go to a daily chart now, because this is easier to see here on the daily chart. And we do have some other resistance level a little bit higher as well, but this is what we are looking at in terms of on the daily chart, 44.30, and looks like we might actually get there. We are really close. We just came close enough in terms of the points, so that ABCD pattern in my books is actually complete. Could the price move higher? Yes, it can, certainly. We have a little bit higher levels on the weekly chart as well, but just concentrating on the daily chart, this 44.30 is the level which has been met. Let's actually pretty much is there. Let's also take a look at the NQs. So for the NQs, we were initially looking at the 14,350 as a stronger resistance because of the confluence level, and obviously the market is way above that, so that pattern failed. There was around this mark a little bit of consolidation, but then market is too strong, and also on the ES we were looking for higher numbers, and we did talk about that, that the momentum in this market is so strong that we could in fact see higher prices. The other level that is coming out, which is approaching, is 15,421. That is the 78.6% Fibonacci retracement of these all-time highs reached back in November of 2021. So this is what we'll be paying attention to, and the key thing to take a look at is actually what the Federal Reserve Bank of New York actually spoke about in terms of their model telling us about significant decline in the trend for inflation. So that's kind of good news. One more thing which I had discussed in my previous video done for the stock indices is basically this sentiment survey done by the AAII. This is a sentiment survey of professional investors, and the interesting thing is that just thinking about the counterfactual, while we were looking for higher prices in the major stock indices, the majority consensus of professional money managers was actually bearish. So you can see that 17th of May only 22.9% bullish. Look at 39.7% bearish, and then 24th of May 27.4% bullish, 39.7% bearish. And then what we have had is basically people who were neutral moved into the bullish part. And look, what happened between the 31st of May and 7th of June is a big increase in bullishness. So while there was a lot of bearishness out there in terms of the belief, or at least by looking at the survey, uh, we were looking for higher prices. Market was creeping higher. Maybe now it's time to also fasten our seatbelts a little bit. Maybe just from a counterfactual perspective, um, we might enter an air pocket where we could have some meaningful correction, for example. This is something which we'll just pay attention to. So, guys, thank you very much for watching the video. While we are still on it, I think I'll just quickly have a look at the treasury bond futures as well. Um, so here, the treasury bond futures, they have been trying to rally, but they get significant resistance come in. So the key level that we were watching for is this one. This is the 125.04. This is 78.6% retracement of these lows here. If the market doesn't respect that and actually breaks down out of this range to the downside, that's going to be pretty negative. And of course, the bond price and the yield is inversely related. And what it could mean is lower prices means higher yields. So that's going to be a negative. Then if we just quickly take a look at the 10-year notes. So this is the chart of the 10-year notes. Similar kind of picture. We do have this rising trend line here. It's kind of hovering between the 61.8% and 78.6% Fibonacci retracements. But if it begins to close below 111.28 or take these lows out, that's a pretty bearish scenario in my opinion. So guys, this is what we are watching in terms of the uh, key US stock market indices. Also, we quickly looked at the bond markets. The important things which I wanted to discuss was this inflation figures which came out, and also the Federal Reserve's MCT model. And if you like the way we do the analysis, then please do subscribe to the channel. And if you like the video, please do click the like button. Thank you very much for watching. Good luck and good trading.